Hi all, this is Dr. Hart. Welcome to Political Science 208, Survey of State and Local Government, Lecture 4, State and Local Taxes. In this lecture, I'd like to do something a little bit different and really to zero in on three big concepts: sales taxes, property taxes, and municipal bonds, and give you some specific examples of how sales taxes, property taxes, and municipal bonds work, and also to give you some of my thoughts on the utility and fairness of these taxes, and to offer you some possible different ways of thinking about whether or not sales taxes and property taxes as they exist today are fair or not. So sales taxes are taxes on any items that are being sold, and sales taxes account for approximately 15% of state and local tax revenue. Now, typically, food items that you buy in a grocery store are exempt from sales taxes, which is a great incentive to actually buy food from a grocery store rather than go out and eat, because you save money not only on service and huge markup that you get on food, but you also save money on taxes. Now, some states also exempt electric and gas utilities from sales taxes. Let's think about these two items. First, exemptions for grocery items, and second, exemptions for electric and gas utilities. Now, why is this the case? Why do these exemptions exist? To help out the poor, or at least that's the most obvious reason, that's the surface reason, and I think that really is the reason if you dig deeper. It is sometimes argued that sales taxes are regressive, meaning that they hit poor people harder, because when poor people pay the same tax rate as everyone else, as the middle class or the rich, it takes a bigger portion of their income out, and therefore this is a regressive taxation because the poor pay a greater portion of their income in taxes. Now, what does every person need, including every poor person, as a base at least? He or she needs food, and he or she needs to pay basic utility bills. So by exempting these, right, by exempting these from taxes, you make it much easier for the poor to pay their bills. Sales taxes, they vary from state to state, and sometimes even from county to county. Now, sales taxes are especially important to state governments. Roughly 80% of all sales taxes go into state coffers. Most states also allow at least some counties and cities to levy additional sales taxes, and currently about 7,500 localities do so. Now, let's ponder the fairness of sales taxes. Are they regressive the way that they exist today? Well, I would say no, because as we discussed above, food and in most cases electric and gas utilities are exempt from state taxes. That's one consideration. Another consideration is that middle class people and rich people buy more. They spend more than poor people, and therefore they pay more in sales taxes. Sometimes more even in proportion to their income than poor people do. The general pattern is that the greater your income, the more money you spend. Now, there are, of course, as always, exemptions to this general pattern, but the pattern is exceptionally strong. So the more money you make, the more you spend, because it's so easy to do so in modern societies today, including, of course, in the United States. Spending money is easy. Accumulating money is hard. So middle class and rich people buy more stuff, and therefore they just and use more services. Therefore, they pay a lot more in sales taxes than do poorer people. So that's my thought on sales taxes. Property taxes is our next item. Now, while sales taxes are the biggest single source of revenue for states, property taxes are the primary funder of local governments. In 2015, state and local governments combined raised about 488 billion in property taxes, with the vast majority of that going to local governments. And here I would like to point out that school districts are a type of local government. Now, you might already be familiar with this idea, but it literally is true. So, take as an example Clark County School District, the fifth largest school district in the country, in the United States. Perhaps you even went to school in Clark County School District, or perhaps your children are going to school in that district now, fifth largest in the country. Now, where does the bulk of the money come from? It comes from property taxes. It's an interesting idea, especially in the 21st century, just how fair or unfair property taxes are. Some people say, well, richer neighborhoods have better funded schools. Why? Because richer neighborhoods have higher property values, both residential and commercial real estate, and higher property values means they collect more taxes in property tax revenue, and so they have more to spend. Okay, true enough. But it is also true that on balance, again, there are exceptions, but on balance, rich people have fewer children than poor people, and therefore have fewer children in public schools. Also because rich people and upper middle class people very often send their children to private schools and therefore derive no benefit at all, from not immediate benefit from public school districts being funded. So today the breakdown is approximately 12% of all children who go to school in the United States go to private schools, and about 88 go to public schools. And there are some that are a relatively negligible number that are homeschooled, and most states only allow you to homeschool after a certain age. So almost everybody who is a child under 16 goes to either private and public schools, and the breakdown is 12% and 18%, respectively. It may fluctuate slightly from year to year, but it has been stable at about this number for many, many years now. And also, please note that if one of your goals in life is financial security, what you may want to do is to pay off your mortgage. So by the time that you retire, you don't have that hanging over you, because by the time you retire, your income is going to be less, probably, than what it was when you were, in fact, working full time. And your mortgage or your rent is typically the biggest item in terms of your expenses. So many people, and I think wisely, what they try to do as part of the overall strategy of financial security to pay off their mortgage. And the strategy still makes sense. But you do have to keep in mind that your mortgage is never truly paid off, because there are always property taxes involved in perpetuity. And if you don't pay those, then your county or your state will put a lien on your house, and you will lose your house or a condo or a townhome. Whatever that property is, you're going to lose it if you refuse to pay property taxes. Now, is it fair to people whose children have grown up a long time ago and haven't been in a public school system for decades? Is it fair for them to ask them to pay property taxes so that public school districts could be funded? And even more poignantly, what about people who never had children? Is it fair to ask them to pay the same in property taxes as people in their general neighborhood who have 3 or 4 children in public school? I don't have an answer for you. This is up to you to decide. This is just one of the things that I wanted to point out because it's not necessarily on the radar of most textbooks. And the last item is about homeowner associations, which are private associations. However, their bylaws and their resolutions, for all practical purposes, have the force of law. One of the things that you have to do if you own any property is to pay your HOA fees. So this is kind of hand in hand with local property taxes. It's a separate item, but it's also a requirement. And if you refuse to pay HOA fees, and you do live in a community which has an HOA, which increasingly in this country, the majority of all residential communities, if you refuse to pay your HOA dues, guess what? The HOA will put a lien on your house, and you will lose your house. So, if you happen to live in a state like Nevada, where property taxes are generally low, and where HOA fees in most neighborhoods, not in all, are generally low. If you go to like Spanish Trails or maybe Summerlin, you will encounter some high HOA fees. But in most neighborhood, HOA fees are still quite reasonable. So if you do happen to be lucky, and let's say you only pay, I don't know, maybe $1,200 or $1,300 a year in property taxes, and maybe $600 a year in HOA fees, that's close to $2,000. So for 2021, that's pretty reasonable. That's pretty low. You still have to understand that that's $2,000 a year just to make sure that your property is not taken away from you. Even though you thought that you had paid it off, you just paid it off to Fannie Mae, which is the company, the corporation that actually holds the vast majority of residential property debt in this country. So when you pay monthly mortgage payments, let's say, to your bank just services your mortgage. It doesn't own it. It's most likely owned by Fannie Mae, especially if you are in the state of Nevada, where Fannie Mae owns about 90% of all residential real estate debt. So you paid off your mortgage, and you are about to retire. And if you haven't realized, you will realize at that point, well, there's still about $2,000 a year that I have to pay just to make sure I do not lose my property. This is not so much criticism of the system as information. I want you to think that private property is not necessarily fully private, as Justice Morrison Wade put it in Supreme Court's 1787 decision in Munn versus Illinois. Once private property is closed with some kind of public interest, it's no longer fully private. So once you buy your shirt, you never have to pay taxes again on your shirt, no matter how long you keep it and use it. But if you buy a condominium, you have to pay taxes on it forever, right? Because kids have to go to public schools. And you pay HOA fees because property has to be maintained to be in a decent shape. So something to think about. Now, third and last item is municipal bonds. And here I have three short paragraphs. They are a quote from article How Are Municipal Bonds Taxed from Investopedia. I would like just to summarize it for you instead of reading it all verbatim. Municipal bonds are financial valuable paper which municipal government issues, and in exchange you give money to a municipal government. So it's a way for municipal governments to get money that they otherwise do not get from other sources like taxes and fines and forfeitures. So it's an obligation to pay. This is basically the debt that a municipal government issues, and if you buy it, then for you it's an asset, because in exchange for giving them this money, this bond entitles you to collect a certain percentage in interest every single year. And currently, if you are in the United States, many municipal bonds pay between 2 and 3% interest rate, which is slightly higher than the rate of inflation. One of the good things about municipal bonds is that they're typically exempt from federal taxes and also often exempt from state taxes. Why is this an advantage? Well, clearly because you can preserve your capital and do so at virtually no risk. So it's not a huge money-making opportunity, but it's good for retirement. If you're approaching retirement and let's say you have saved $1.5 million, $2 million in your retirement account, then when you take this money, what you don't need in order to live, you can invest in municipal bonds and basically get a secure return of about 2.5% tax-free for the rest of your life. Once you won the financial game, there's not necessarily a reason to continue to play on. And you just park your money where it's safe and where you can at least keep up with inflation and not pay the taxes that you do not need to pay. So in this respect, municipal debt is an attractive investment opportunities for people who have a sizable retirement account and want to have secure income. So that is the bottom line with taxes. Now, in general, I want to comment that taxes, sales taxes and property taxes do vary a lot from state to state, and the biggest hit occurs on property taxes. It's not unusual for states like New Jersey and New York to impose high property taxes. And because real estate values in those states are much more expensive than, let's say, in Nevada or Alabama or Florida, people very often, when they reach a certain retirement age and have saved some money, don't feel they want to work full-time anymore and become retired or semi-retired. They do move to Nevada, Utah, Florida, Alabama, South Carolina, because what they can in fact do is avoid paying extra thousands and tens of thousands of dollars in property taxes. Because for the property that they own in New York, if it, let's say, is a $1 million residential property, the same property in Nevada or Utah will cost a small fraction of that, maybe $200,000. And because the tax rate is also much smaller, they're saving a great deal of money. So high property taxes in combination with high real estate values is one of the things that has been driving a lot of people away from older northeastern and midwestern cities to the south and the southwest. It's not just the climate, it's not just more sunshine, as it's sometimes portrayed, that people just are moving for lifestyle and they want more sunshine in their lives. It's just that they want to keep more of their money in their lives, and they're ditching expensive property values and high taxes in favor of keeping more of their money. Thank you.